Dollar stores sell millions of items every day. Parking lots are full. Aisles are crowded. New locations open constantly. Yet despite nonstop sales and relentless expansion, most dollar store chains earn far less profit per store than people assume. Some struggle to generate meaningful returns at all. The contradiction is simple. High volume does not guarantee high profitability. The tension sits at the core of the model. Dollar stores rely on extremely low prices to drive traffic. Low prices compress gross margin, the difference between what a product costs and what it sells for. To compensate, they depend on volume and tight cost control. The more they push volume, the more complexity they introduce. The thinner the margins, the less room they have for mistakes. Profit lives in a narrow space between scale and fragility. Dollar stores have reshaped retail in many communities. In rural towns and low-income urban areas, they often replace grocery stores and small retailers. Expansion appears inexpensive. Store footprints are small. Build-out costs are modest. Thousands of locations create the impression of a simple, repeatable formula. The economics begin with pricing. Many items historically sold for $1. Even as prices rise, the brand remains anchored to low cost. That anchor shapes expectations. It limits markup on any single item. Gross margins are thinner than many consumers assume. To protect margin, dollar stores rely on private label products and opportunistic buying. Private label means goods produced under the store's own brand, often sourced at lower cost. Opportunistic buying involves purchasing surplus or close-out inventory at discounts. Both reduce cost of goods. Both also create variability in supply and assortment. Inventory management becomes delicate. A small store carries thousands of low-priced items. Each SKU generates only modest profit per sale. Inventory turnover, which measures how quickly goods are sold and replaced, must stay high. If products sit too long, rent, labor, and shrink erase the margin. Shrink is a constant pressure. It refers to inventory lost to theft, damage, or error. Dollar stores often operate with minimal staffing. 1 or 2 employees may run an entire store. That lowers labor cost but increases exposure to theft and operational mistakes. When margins per item are thin, even small losses compound. Labor is a balancing act. Staffing levels are kept low to preserve operating margin. Low staffing leads to cluttered shelves, slower restocking, and longer checkout lines. Customer experience weakens. Sale potential declines. Efficiency protects profit in theory, but it can erode revenue in practice. Real estate seems like an advantage. Dollar stores target small, inexpensive locations. Rent per square foot is low. Construction is simple. Expansion looks cheap compared to big box retail. Chains open hundreds of stores per year. Revenue grows. Expansion introduces a second order problem: cannibalization. Cannibalization occurs when new stores pull sales from existing locations instead of creating new demand. In dense markets, stores begin competing with one another. Same-store sales, which measure revenue growth at established locations, flatten. Total store count rises, but profit per store weakens. Dollar General illustrates this dynamic. It operates more than 18,000 stores across the United States. For years, disciplined expansion and standardized operations produce steady growth. Small footprints, lean staffing, and limited assortments kept costs controlled. Investors rewarded the model. pressure emerged as inflation, wage increases, and supply chain disruptions intensified. Dollar General's customer base is highly price sensitive. Small price increases can change purchasing behavior. To protect traffic, the company absorbed some cost increases instead of passing them on. Gross margins narrowed. At the same time, shrink increased across retail. Lean staffing amplified the impact. Inventory losses rose. Stores became more cluttered as labor hours tightened. Customer experience deteriorated. Same-store sales growth slowed. To offset margin pressure, Dollar General accelerated store openings and expanded into categories like fresh produce. That required new logistics capabilities and refrigerated supply chains. Complexity increased, capital expenditures rose. The simplicity that once defined the model began to erode. Revenue continued to rise because the store count expanded. Operating margin, which reflects profit after operating expenses, compressed. Growth masked weakening unit economics. The challenge is structural. Dollar stores operate on low price perception. That perception limits pricing power, the ability to raise prices without losing customers. Pricing power in this segment is weak. Customers substitute quickly when prices move. When costs rise, choices are constrained. Cutting labor risks operational breakdown. Raising prices risks losing traffic. Reducing assortment can risk shrinking basket size. The buffer is thin. The broader lesson extends beyond dollar retail. Businesses built on extreme affordability require precision. Full parking lots and busy aisles suggest strength. But when profit per transaction is small, stability depends on tight cost control and disciplined expansion. Dollar stores do not struggle because customers disappear. They struggle because their model leaves little margin for error. Small increases in cost, modest growth in shrink, or slight overexpansion can erase a significant share of profit. Nonstop sales create activity. They do not guarantee resilience. In dollar retail, motion is constant. Margins are not.